Hello friends, welcome to Learning with Z. This video is the first in the series of financial ratio analysis as an important tool for financial statement analysis. This video will focus on concept of financial ratio analysis and its significance, and we will see liquidity ratios in detail in this video. I would be uploading several videos, one on each type of financial ratio, to help you understand the concept easily in a very simple manner. So let's begin with the concept of financial ratio analysis. Financial ratios are an important technique of financial statement analysis. Ratio analysis is very important to understand the financial statements, for identifying trends, for measuring the overall financial health of a business. Often, lenders and potential investors rely on ratio analysis to make their lending and investment decisions. Financial ratio is a relationship between two accounting numbers in the financial statement. It exhibits a mutual cause and effect relationship between the two. That is, if one rises, what is the impact on the other? Like if sales rises, then what is the impact on the current assets? Or if debtors rises, what is the impact on the payment period? Ratio analysis helps us to make a quantitative and qualitative judgment about the firm's financial performance. That is, they are important tools that help in judging the profitability, efficiency, liquidity, and solvency of any business enterprise. They are also helpful in forecasting decisions, and they help the management to set specific goals that are achievable over a period of time. Ratio analysis is an important technique of financial statement analysis. Financial ratios are useful indicators of firms' performance and to analyze the financial situation of a company. It helps us to judge the various situations like profitability situation, efficiency, liquidity, solvency position of an entity. It also helps to analyze trend over time. It helps in forecasting and in setting proper goals for the management for achieving them in due period of time. Commonly, financial ratios are categorized as profitability ratios, efficiency ratios, liquidity ratios, solvency ratios, and market ratios. Depending on the users, like bankers, creditors, investors, sometimes regulators, they use these financial ratios to analyze the financial situation of a company for their own decision making. For example, creditors decide to lend or not based on the credit ratios like solvency ratios and sometimes liquidity ratios. Similarly, potential shareholders or investors would choose whether to invest in a company or not based on the profitability ratios, efficiency ratios, and the equity ratios. For the purpose of this video, we will be looking at the liquidity ratios first. And in the subsequent videos, I will be taking up each and every ratio in detail. Liquidity ratio measures a firm's ability to meet its current or short-term obligations. That is, whether the company is liquid enough to repay its short-term debt. The better the liquidity of an organization, the higher is the soundness of its working capital and higher are the growth prospects. Liquidity ratio measures whether a company is doing great or not in terms of its day-to-day production or day-to-day business, without the trouble of getting into the risk of bankruptcy by not paying its short-term debts. Liquidity ratios are of three types: current ratio, quick ratio, also known as liquid ratio. The third one is cash ratio, also known as absolute ratio. Let us look at each one of them in detail. Current ratio is the ratio of current assets to current liabilities of a firm. It is the first ratio of liquidity. By formula, it is equal to current ratio equals to current assets divided by current liabilities. This ratio measures whether the firm has sufficient current assets or not to meet its current liabilities as and when they arrive. that is, whether it is able to pay off its short-term debt or not. An ideal current ratio is considered as 2:1, which shows that the firm has more than current liabilities, its current assets, that it can use to pay off its short-term debts. A current ratio of 1.33:1 is a minimum acceptable level for working capital financing decisions. That is, the lenders often look at the current ratio to make their financing decision for the firm. If the ratio is less than this, the lender might as well not choose to give finance to the company. So a company needs to maintain at least 1.33:1 ratio in order to achieve the financing from the lenders. Although a higher current ratio may be considered as better, but it's not always so, because it can lead to adverse impact on profitability. It is therefore important to look at the constituents of current assets to evaluate its liquidity position correctly. For example, if the current ratio is, let's say, 4:1 or 5:1, then it might show that the cash is lying idle with the firm. There is a lot of pile of cash with the firm which it is not using for any profitable investment. Similarly, it might be that the debtors are really high in the balance sheet, which shows that the firm is not really good at collection from the debtors. Or it might show that the firm has a huge pile of inventory, that is finished goods, and that is it is not able to sell off its goods on time, or a lot of raw material is lying idle because there is a lag in the production process. Therefore, it is very important to analyze current ratio with respect to each and every constituent of current assets. Another type of current ratio that is of importance is quick ratio or liquid ratio. The quick ratio measures the firm's capacity to pay its current liabilities without the need to sell its inventory or obtain its additional financing. It is a more refined and conservative measure than current ratio because it does not take into account inventory, which is the least liquid asset. By formula, liquid ratio is equal to current assets x of stock and prepaid expenses divided by current liabilities x of bank overdraft and cash credit. An ideal quick ratio is 1:1. Quick ratio is also known as asset test ratio because it gives instant result to the creditors to make the financing decision. If the liquid ratio is less than 1, for example, if it is 0.5:1, it reflects lower cash positions that may lead to credit repayment problems. If the liquid ratio is more than 1, then it reflects excess cash lying idle or large size of debtors in the balance sheet. This may further reflect the need to analyze the quality of debtors as a concern and if it needs careful assessment or not. Also, the firm needs to look at its average collection period versus average payment period and whether they need to be improved or not. Cash ratio or absolute ratio is the most conservative ratio out of the three types of liquidity ratios. As the name implies, this ratio is simply the ratio of cash or cash equivalent securities to current liabilities. This ratio looks only at the cash position of the company or those assets that can be readily converted into cash like the marketable securities to pay off the short-term debt. It does not consider receivables or inventory. By formula, cash ratio is equal to cash plus marketable securities divided by current liabilities. The most significant aspect of cash ratio is that it shows the company's ability to pay off current liabilities on an immediate need basis. That is the immediate liquidity position of the business. 1:1 is considered as a satisfactory or ideal cash or absolute ratio. So friends, I hope you have found this video useful. The purpose of creating short videos is to help you understand a particular concept in a simple and the easiest possible manner. I would be uploading similar kind of short videos on several ratios and other aspects of financial statement analysis. To watch more such useful videos, please subscribe to my channel. If you like this video, please press the like button and also don't forget to press the bell icon to know the latest updates. Thanks for watching.